Okay, class. So today we're going to be talking about Chapter 7, which, as you can see here, we're going to be discussing merger and acquisition strategies. So in Chapter 6, what we just got done discussing was diversification. This idea that companies diversify their portfolio and essentially they operate in different product markets and different industries. They have different seemingly related or unrelated products. In this chapter, we're going to discuss one way that companies diversify, and that is through a merger or an acquisition. As always, please look over the learning objectives. This is just an awesome tool to be able to help you study for your exam. All right, so in this course, we really talked about two levels of strategies. We've talked about your business level and your corporate level. So again, this is relating back to Chapter 4 and Chapter 6, respectively. Your business level, this is a strategy for a specific business segment serving a specific product market segment. You can have the 5 different generic business level strategies, all about positioning yourself in that product market segment, differentiation, cost leadership, etc. Then we talked about corporate level. Again, it's concerned with diversification, and as I previously mentioned, this chapter focuses on one way that firms diversify and increase their levels of diversification, and that is through what we call M&A, or mergers and acquisition strategies. So the next 3 bullet points that I want you to look at are what we're going to be focusing on. We're going to talk about mergers, acquisitions, and takeovers. Now, in your notes, it's important to note what I have on the PowerPoint screen in parentheses. That mergers are friendly, so are acquisitions, but there are one that is unfriendly, and we call these takeovers, or as I would ask you to write in your notes, some people call hostile takeovers. So let's talk a little bit more about that. So what are the differences between these 3? Well, there are important differences, and you'll need to know this for the exam, so hopefully we can work out and kind of talk a little bit about the conceptual differences between all 3 of these. So first we have a merger. By definition, this is when 2 firms agree to integrate their operations on a relatively co-equal basis to create another firm. This is when Company A buys out Company B and they create another new firm. Company A and Company B do not exist anymore, but Company C, the resulting merger, exists. So let me give you an example of this. Recently, SunTrust merged with BB&T, both banks. And then this year, the merger resulted in a newly created company that is called Truist Financial. So one company, again, bought another company, SunTrust, merged with BB&T, and then they created a newly merged company called Truist Financial. Again, as you can see in the definition, oftentimes this occurs between relatively co-equal firms. Just as a side note, when they do, you might hear the term mergers of equals because that's what it's essentially talking about. But the important distinction here is that they create another third firm, and that both companies, A and B, SunTrust and BB&T, do not operate independently anymore. So that's a merger. The second type is an acquisition. Now, this is just when one firm buys controlling interest in another firm, and they make that firm what we call a subsidiary business. So this is when Company A buys Company B, but instead of creating another company, they still operate. They both still operate. Company B still exists. However, it is just being dictated and owned by Company A. So let me give you an example of this. A great example, I think, that most of us would be familiar with is when Amazon bought out Whole Foods. Jeff Bezos, the CEO of Amazon, recently bought out Whole Foods, the grocery store chain, and bought 100% controlling interest in this company. Now, the reason this is not a merger is because there was not a third company that was created. Both Amazon and Whole Foods still exist. However, that's the component that makes it an acquisition. You can still walk into a Whole Foods today. It is just a subsidiary business within the portfolio of Whole Foods. They diversified into the grocery store market. Amazon did. And then lastly, we have takeover, or what many people call hostile takeovers. And so a takeover is an acquisition, but it's just a specific type of acquisition. It's an acquisition when the target firm did not solicit the acquiring firm's bid for outright ownership. We often see this is called an unfriendly acquisition or a hostile takeover. Again, this is when the target firm, Company B, did not solicit the acquiring firm's bid. And so there are a number of ways how this occurs, very political, sometimes very unethical ways, but yet legal ways here in the US, but that's outside of the scope of the content for the course. And just know that takeovers are unfriendly, and we call these hostile takeovers, and it's just a type of acquisition. So this is Chapter 7. In Chapter 7, we're going to be talking about two major things. We're going to be talking about, first, the 7 reasons why companies acquire other firms, and then second, the 7 primary issues or concerns or problems when achieving acquisition success. So for the remainder of this lecture, I'm going to go through the 7 reasons for the acquisitions. And then when we pick back up to talk about the remaining components of Chapter 7, we're going to talk about the 7 primary problems in achieving success. Okay, so let's first talk about the 7 reasons for acquisitions. The first one we're going to talk about is in the top left corner of the green oval, and that is to increase market power. The primary reason that firms acquire other firms is to increase market power. And so as you learned in Chapter 5, market power is just an ability for a firm to sell goods at above competitive levels or to cut cost compared to their competitors, therefore giving them some type of competitive advantage, right? And this is when a firm's size, all of its resources and capabilities, gives it a superior ability to compete. And again, this is the primary reason why firms acquire, to increase market power. And so while firms do this, and we see this all the time, Apple and Facebook, Google, they're great examples. If you know a little bit about the healthcare industry, Valeant was a company that acquired quite literally anywhere between 10 and 100 companies per year. They do this to increase the power within a specific market. However, as the second bullet point notes, these acquisitions that are intended to increase market power, the specific ones that are increasing market power, they are subject to not only regulatory review, but also analysis by financial markets. And so these are 2 different types of governance systems. So first is the regulatory review. This is conducted by the SEC. One that went on for multiple years was Time Warner and AT&T's merger, because resulting critics would suggest that it might be too big and you need some type of regulatory review in a country to be able to make sure that monopolistic companies don't exist. So acquisitions intended to increase market power go through this. But not only that, kind of a more informal governance system is the analysis by financial markets. Oftentimes, financial analysts can put so much public pressure on a company and saying that it's such a bad deal that you'll see companies that have agreed to merge or to be agreed to be acquired, they actually back out of the deal. We call these broken deals. So that's the first primary reason that companies acquire. And so when we talk about increasing market power, it's really increased by 3 manners. Increased first by horizontal acquisitions. And these are acquisitions when other firms in the industry are bought out by another competitor, like HP and Compaq, or by vertical acquisitions. This is when a company acquires its either suppliers or distributors. A great example of this is Apple. They often buy their suppliers, and they do so to control different parts of the value chain. And then lastly, related acquisitions. Because related acquisitions perform better and they're highly related and often come from the same industry, this helps firms increase market power. So overall, that's the first reason for why, and it's really the primary reason why companies acquire other companies. The second reason that we're going to talk about today is to overcome entry barriers. So what are entry barriers? Well, you learned this in Chapter 5. Entry barriers are factors associated with the market, and more specifically, associated with a company's ability to engage immediate access into a specific market. And again, when we talked about the external analysis in Chapter 3, more specifically Porter's 5 forces, we talked about all of these, what we call barriers to entry or entry barriers. And again, we talked about stuff like economies of scale and differentiated products, both of which, when they are high in a specific product market, it's a big obstacle for a company to overcome. So we see that companies buy other companies to kind of overcome this obstacle. However, more specifically, we see this happen very frequently internationally, and we call this cross-border acquisitions. These are acquisitions made between firms with headquarters in different countries. And again, they're made to overcome entry barriers, but more specifically, the entry barriers are even higher because it's difficult to operate in a country that you don't know. You don't know their culture, you don't know their regulatory processes. So what we see is companies, instead of creating a company and developing it, creating a product and developing it in that specific company, they will go out and buy a firm that they want access to that market. And by doing so, it already drives down any type of entry barriers that may be in the way. So a great example of this is the Malaysian market, or more specifically when Jet Etihad acquired Air Asia to enter the Malaysian market. They did this only a couple of years back, and this is two airline industries. And Jet Etihad acquired Air Asia to get immediate access into the Malaysian market because they thought it was going to be a very profitable market in the future, and actually it was. According to their stock, it's done very well. Okay, so that's the second primary reason why companies acquire. The third reason why companies acquire is based on this make versus buy scenario. So we talked a little bit about this. We talked a little bit about this in chapter 4 when we talked about business level strategies. I mentioned that every company has a decision. We call this the make versus buy scenario. You can make a product in-house or you can buy a product from another company. This acquisition, this is the exact buy scenario. And so oftentimes, because internal development of a new product we call R&D, because R&D is very risky and you don't know if you'll get some type of success out of it, firms will actually go out and buy a product in an industry that they want to. And so they acquire these companies because of two main reasons. First, firms acquire because the cost of the new product development in a specific product market is high. And two, the desire to increase the speed to enter a specific product market. And a great example of this is Facebook acquiring Instagram. So right before this happened, Mark Zuckerberg, the CEO of Facebook, he came out, and I remember reading, he came out and said, we knew that we wanted to get into that aspect of social media, the photo-based social media platform. And so instead of spending millions of dollars into R&D to produce a competitively similar product, I just went out and bought Instagram because it was less risk. And not only that, it got me immediate access more quickly. So again, the third reason why companies acquire is because either the cost of the new product can be very high or they want to increase speed into a market. So that's the third reason for acquisitions. Now this fourth reason is very related, so I'm going to kind of group it into that third reason. But the fourth reason, which is related, is that there are oftentimes lower risk compared to developing new products. So the main point here is that for acquisition outcomes, for all acquisitions, they can be predicted or they can be estimated more easily than the outcomes of R&D or the internal product development process. This is a fancy way of saying kind of what we just talked about. That's why it's related. Facebook thought, and it's very true, that if I went out and buy Instagram because I see how it's performing, I can estimate or I can predict performance more accurately than I can based on some imaginary product that I could develop over the next 3 years that's going to be a competitor. So because of that, we'll see that executives, they perceive that there's lower risk in acquisitions compared to R&D, so this drives acquisitions. And so there's benefits and detriments to this. So the benefit is that managers view acquisitions as lower risk. However, we've seen over time that acquisitions discourage or suppress innovation. A great example of this occurring is Facebook acquiring a virtual reality gaming company called Oculus Rift. Mark Zuckerberg said kind of the same thing he said of Instagram. There's lower risk. Instead of spending millions in developing a virtual reality gaming company, I knew that's a product market that I wanted to be in, so I bought Oculus Rift. Another great example of this, if you know a little bit about the healthcare and pharmaceutical industry, is Valeant. Valeant is a company that saw incredibly high successes, and they have seen very, very, very low lows, and that's where they currently are now, because what they did, which was completely legal, they cut out all their R&D expenditures, and they went acquiring tens, if not hundreds of firms over a span of 5 years. And the reasons why is because they suggested this. Managers, the CEO, viewed acquisitions as lower risk, but what it did is it discouraged and suppressed innovation. To do so, they had to cut R&D, which ultimately killed their company. And other reasons if you know more about that story, but that's the general kind of consensus. Okay, so that is the fourth primary reason why companies acquire. So the fifth reason why companies acquire is to increase diversification. Now, I'm not going to spend too much time on this because it's just rehashing what you learned in Chapter 6. So companies acquire, or they use acquisitions to diversify a firm's portfolio. So why do they use acquisitions? Well, it is the quickest and the easiest way for a company to diversify. And not only that, as you learned in Chapter 6, related diversification and unrelated diversification, so all diversification, it can be implemented through acquisitions, and this mitigates risk for their firm, right? They are spreading or diversifying their portfolio. They're spreading out the risk of their portfolio. And not only that, if they acquire related companies, right, if they increase market power, this has a greater probability that the acquisition will be successful, as a greater probability that performance will be resulted from the acquisition. So again, the exact thing that you learned in Chapter 6 and that we talked about, the fifth primary reason why companies acquire is to increase their diversification levels and just diversify their portfolio, both to mitigate risk and to increase performance. So the sixth reason that companies acquire is to reshape their firm's competitive scope. So kind of like you learned that in Chapter 6, you've already learned this as well based in Chapter 5 when we talked about competitive dynamics. So acquisitions often occur, and we've seen this for the last 20 to 30 years, they often occur more frequently in industries or product market segments when competition is high. And so why is this the case? This is the case because acquisitions often reduce the negative effect of intense rivalry. So when rivalry is high, like in the high-tech industry, it's a great example of this. If you acquire another firm, this reduces the negative effect of intense rivalry. You're basically acquiring, or you're eliminating your competitor. But also, if you diversify outside of your portfolio, it can reduce the firm's dependence on one or more products in that specific market. And again, this was the basis for Chapter 5. So I'm not going to talk about it too much because that's what we're talking about. We've already talked about this in that lecture. But the general notion is that acquisitions reduce the firm's dependence on specific markets, and not only that, it alters its competitive scope. It alters the intensity of rivalry within an industry. And an important note at the bottom, this usually happens when firms move from a broad business level strategy down to a more focused business level strategy. So that is the sixth reason why companies acquire. Again, it's based on competition that you learned in Chapter 5, and that is to kind of reduce competition and reduce the dependence on a specific product market segment. So the last reason, or the last primary reason for why companies acquire another firm, is to learn and develop new capabilities. And so it's all about organizational learning. Actually, when I teach this at the graduate level, I have a whole chapter on organizational learning. So this is a very, very important concept, but we're not going to be able to get to it in this course just based on time constraints. But organizational learning is incredible, especially in today's society, and especially in industries like the high-tech industry. And often the best way for a firm to learn new things or to develop new capabilities is to acquire another company. And we see this all the time. Firms acquire and they gain access to capabilities like special technological capabilities, like patents, for instance. If you can't, like in the pharmaceutical industry, which I've talked a little bit about, if you can't sell another drug because of a patent on it, you can acquire that firm and get that patent and start selling it yourself, or make generic products because you own the patent. Not only that, firms also acquire to gain a broader knowledge base. One of the main reasons why Mark Zuckerberg of Facebook bought Oculus Rift was because he wanted to understand the virtual reality gaming industry better. And buying that company gave him a broader knowledge base of that specific industry because of the executives that work there. And so an important note on this, that firms should acquire other firms if they want to learn with different but related and complementary capabilities in order to build their own knowledge base. So when firms want to acquire to learn, it needs to be companies that have different but related and complementary capabilities. Oftentimes, these are very similar firms that do not exist in the same industry, just to put it in practical terms. So those are the 7 reasons for acquisitions. So we talked through all 7 of those today. So the next lecture, we're going to be moving in and we're going to talk about the 7 main problems in achieving acquisition success. All right, so we recently talked about the 7 reasons, or the 7 primary reasons for why companies acquire other firms. So now let's turn our discussion to the 7 major problems for acquiring firms to achieve success. Now, it's important to note here that something that the book really doesn't mention, but on average, all acquisitions actually lead to lower performance for firms. Oftentimes, they still benefit a firm because they can increase market power or you can overcome an entry barrier, 2 of the 7 reasons why firms might acquire. But in terms of just general performance directly related to the acquisition, it's oftentimes negative. So then that bears the question, okay, then why is this the case? Well, to answer that question, we are going to go through what research has shown to be the 7 major problems for firms to achieve some type of higher level performance or some type of success. So the first one that we're going to talk about is integration difficulties. This is the primary reason for why firms do not achieve acquisition success. And so there are a number of them that you can see here on the PowerPoint screen. But I really want to highlight 2 that the book spends the majority of the time talking on. So the first one is the melding of 2 separate corporate cultures. Now, when one firm buys another firm, they're going to have 2 separate corporate cultures. Not only that, you start to create a crisis when an acquiring firm is being taken over by another organization. Some of y'all know me, and I've talked a little bit about my background, and I've had work in this area before, and I worked with many people in Boston Consulting Group in the mergers and acquisitions category or department of that business. And this is something that we have always seen, and this is something that we have always talked about, is that 2 companies' corporate cultures coming together is often incredibly hard to integrate between 2 separate firms, and it really takes a toll on the acquisition's performance. The operations and everything that comes with it is just ineffective at best if the corporate cultures cannot meld together. The second thing that's really important to highlight is resolving problems regarding the status of the newly acquired firm's executives. So this is interesting, and I've seen this in the practical world, and I've seen this in research. On average, more than about 80% of the time, the executives of a target firm, so the executives of the firm that's been acquired, are either fired or they're told they're going to be fired within the first year of the acquisitions. And this creates huge problems, and it kind of links into the corporate culture aspect, is because when executives are going to be fired from the target firm, that creates a huge problem for all the employees. And again, we see this in most companies that acquire other firms. So again, the first problem in achieving acquisition success, integration difficulties. There's lots of integration difficulties, and you can read the other ones, and they are very important, but the book really highlights these 2, so I wanted to highlight them as well. And that is melding the 2 corporate cultures, and then resolving issues of whether or not the newly acquired firm's executives, the target firm's executives, are going to stay. So that's the first problem, was integration difficulties. The second problem in achieving acquisition success is inadequacy in terms of the evaluation of the target firm. Now, this is huge. When a company acquires another company, it has to do what we call its due diligence. So due diligence is just defined as the process of evaluating a target firm for acquisition. This is understanding basically this very subjective notion of answering this question: how much is a company worth? And so if you read up about any type of merger and acquisition, this is the biggest question surrounding it. Because if firms don't do their due diligence, or they don't have the capability of doing correct due diligence, they will result in paying an excessive amount for the company. And that can be detrimental to the acquiring firm. And we call this excessive amount a premium for the target company. And so this due diligence, this evaluation, it requires examining a number of different things. Number one, the finance for the intended transaction. Acquisitions are usually financed between one or two things, usually through cash or stock. And it can be cash plus debt or stock as well. But the real question comes down to, because there's always going to be a component of debt, are we going to pay up front and reduce our cash flow along with taking in some debt, or are we going to take some debt but not give out cash but give out some type of equity ownership to their shareholders as well? So that's the first thing, evaluation. And there's not a right or wrong answer to that question. It is really dependent on the context or the situation or the companies in which are being acquired. So the second evaluation requires examining the different cultures in between firms. As we mentioned in the past PowerPoint slide, melding these corporate cultures is a huge problem for acquisition success. So there's due diligence on this component as well. And not only that, tax consequences of the transactions. We live in the USA. We are the land of trying to get around paying taxes, right? That's why the USA was even created. And this is no different from firms acquiring other organizations. There are many loopholes and companies that take advantage of these loopholes. And this is part of the due diligence, because this is legal loopholes in paying less money for acquired firms. So again, the second reason why companies don't really perform well after the acquisition is because they don't do their due diligence. They have inadequate evaluation of a target firm. So that's the second problem. The third problem that we're going to talk about is related to that financing component, and it's when companies take on large or extraordinary amounts of debt. So it's good that a company will buy another firm. And to be able to buy a multi-million, or most of the time a billion-dollar corporation, companies have to go into debt to be able to do so. Like any big purchase that you would make in terms of a house or a car, companies have to do this as well. However, they have much different avenues of getting money compared to me and you. And not only is just the bank our primarily avenue of getting money, for companies, they can take out a number of different avenues to kind of get this money that they need to buy another company. And one of them that is almost always detrimental to an acquisition is something called a junk bond. Now, a junk bond is a high interest rate. And oftentimes, when companies are strapped for cash, they use this to purchase firms. Now, the use of high debt or the use of junk bonds, it can kill the acquisition success, because it increases the likelihood of bankruptcy. It leads to a downgrade of the firm's credit rating, which, as a side note, most companies that use junk bonds have a bad credit rating anyway. But even more importantly, and if you're kind of emphasizing stuff in your notes, I would like for you to put a star and an asterisk here. It precludes behavior or activities that contribute to the long-term success of the firm. And these activities are like research and development, training for the people in your company, or even marketing, and even an emphasis on good and acceptable accounting and finance practices in the company. So again, the third problem in why companies don't really achieve high performance after an acquisition is because they go into large or extraordinary debt. And more specifically, they often use junk bonds to be able to purchase other firms, which the last time I've read, it was a statistic that less than 10% of firms that are acquiring another firm through the use of a junk bond almost always go bankrupt. So again, that's the third problem in achieving acquisition success. And that's the third problem in achieving acquisition success. And that is a very real practical issue. So the fourth problem that we're going to talk about is a company's inability to achieve synergy. Now let's define this word synergy real quick. So synergy is when assets are worth more when used in conjunction with each other than when they are used separately. So this is a fancy way of saying 1 plus 1 equals 3. If you could write that down in your notes, I would ask you 1 plus 1 equals 3. This kind of fun, kind of tongue-in-cheek mathematical equation represents synergy. It's when two things combined, 1 and 1, are worth more than they would be separately. So 1 and 1 is 2 separately, but in combined, we're saying it equals 3. And that's the idea behind an acquisition. Acquisitions, as we talked about in terms of diversification and earlier in the lecture of the reasons why companies acquire, is because they often try to acquire related firms to create value. Now, this value that is created when two related firms come together, being worth more together than they would be separately, this is what we call synergy. And oftentimes, firms can't achieve that synergy. Why? Well, number one, because it's incredibly hard. It's hard to be able to evaluate what firm is going to provide value that is related to the value that you can provide. And number two, firms often tend to underestimate any type of cost when evaluating the potential acquisition. And oftentimes when costs are high, synergy or the value that could be created between the two firms often becomes lacking. Now, there's another term in the textbook that I have to emphasize because the textbook emphasizes it, and this is private synergy. So the definition of the textbook of private synergy is when the combination of the acquiring and the acquired firm's assets yields capabilities and core competencies that could not be developed by combining any other firm's assets together. It's this idea, in parentheses, if you would write, it's this idea of a perfect match. It is oftentimes looked at the industry level of analysis. We look at, okay, which firms, if they match together, would provide the highest value, and we call this private synergy. However, in practical terms, this is almost never used. Actually, the first time I've ever heard this used was in the textbook, so take that as you will. But to be transparent, I wanted to provide the definition and the understanding of what private synergy is. Again, it is kind of this ideal match. And again, so what does the textbook say? Well, there's an advantage of this. If you could find that out, of course this would be a huge advantage. But the disadvantage, it's difficult to create, and I would even argue it's ideological. It oftentimes doesn't exist. So again, but more broadly speaking, the fourth problem in why companies do not achieve acquisition success is because, more so at the top bullet point, they often have a hard time achieving this idea of synergy, or when assets of two firms come together to provide more value than they could independently. So that was the fourth problem. Now the fifth problem that we're going to talk about today is directly related to Chapter 6 on diversification, and that is when firms have too much diversification. So let's talk a little bit about that. So a huge issue that we see today is that when firms become too diversified, when they have too many products and too many product markets and they operate in too many different industries, we often see that their performance drops. Now, why is this the case? Well, because diversified firms, they must process more information in terms of every other product market segment or every other industry in which they operate. And just in simple terms, it creates a huge control and governance mechanism. It creates huge costs to be able to evaluate how your businesses and all of these different industries are doing, and not only that, how to actually manage those different businesses. And as you can see here in the bullet points, what often happens when firms become too diversified, their strategic shifts focus more on short-term performance compared to long-term performance. And then these acquisitions, because there's too much and there's less stuff going on like R&D because of the short-term focus on performance, acquisitions become substitutes for innovation. So the important point on this bullet point, or on this PowerPoint slide, is the last one. And that we have found in research that there is strong evidence of what we call a curvilinear relationship between diversification and performance. And what this means is that at low levels of diversification, When a company only operates in one industry, performance is low. At very, very high levels of diversification, when a company operates in 1,000 different industries, performance is also very low. But when they operate somewhere in the middle, when they have moderate levels of diversification, if you want to go back to chapter 6, when we talk about related constrained, related linked, these moderate levels of diversification, this is when performance is highest. And if you would graph that on a curve, you would see that it is curvilinear. If you graph that on a XY axis, you would see it is curvilinear. It starts low. In the middle, it gets high, then it declines. That's why we call it a curvilinear relationship. But more importantly, you need to know that too much diversification leads to lower performance, and this is why it's a problem for achieving acquisition success. Okay, so the sixth problem in achieving acquisition success that we're going to talk about is that managers become overly focused on acquisitions. And again, in my short time of working in this industry, I saw this firsthand, and I thought it was just the most remarkable and fascinating thing I've ever seen. And sometimes you will see that managers become addicted to acquisitions, and they invest so much time and energy. Why? Well, because it's looked at. It's a very visible thing in the market. It's, more attractive to investors than just simple R&D. As a quick case study, if you want to take a side note here, look up Navient. I know I've talked about Navient in this lecture, but look up Navient CEO, a pharmaceutical company that was just addicted to acquisitions. It was really the reason why he rose to such short-term, fame, but also the real reason of his demise and why the company is in shambles like it is today. But what you'll see is that these CEOs, they invest so much time and energy into acquisition strategies. They start searching for acquisition candidates. They try to do due diligence. They try to prepare for negotiations. And what this does is it starts to create them neglecting their actual strategic role, which is leading the company. So oftentimes this is why companies outsource this to third-party organizations like Boston and Consulting Group, like McKinsey, like Bain and Company, because there are consulting firms that can come in and handle the merger and acquisition process, so managers don't get addicted or too overly focused, because that is one of the main reasons why acquisitions don't actually pan out, is because not only do they become overly focused, but they become obsessed with these types of activities. And again, I've seen this firsthand, and it's just remarkable. Okay, so that is the sixth problem in achieving success that we're going to talk about. The last one that we're going to talk about is that firms can become too large. And when firms become too large, the acquiring firm more specifically, this leads to problems in acquisition success. Now, why is this the case? Well, when a firm becomes too large, there's just a huge cost that comes with it in terms of the controls that they need, and it starts to exceed any type of benefits like increased market performance or getting into a new market. And again, any type of benefits that stuff like economies of scale or market power would represent. And we see this all the time with companies in the Fortune 500. We see that larger firms, they lead to more bureaucratic controls. That formalized controls lead to rigid and standardized behavior and oftentimes produce less innovation. And they often invest less in stuff like R&D and marketing, just because of the sheer excess size of the company. So again, that is the last reason why companies often have issues post-acquisition. So I wanted to bring up this table for a second, and I just kind of want you to glance over it real quick. But these are just kind of this is an awesome table that talks about the attributes of successful acquisitions and often the results compared to it. I'm not going to go over this table because you can take the time to look at this, and I've also attached the PowerPoint slides as well. But it's just a great table that says, okay, so if they do have problems, then what do successful acquisitions look like? And well, you'll see some of the attributes of them and some of the results on the right-hand side. Now, in addition to talking about acquisition problems, the last thing that we're going to talk about today is what we call restructuring. And so companies restructure in a number of different ways. Now let's define that real quick. Restructuring is a strategy through which a firm changes its sets of businesses or financial structure. And oftentimes, some type of a failed acquisition drives the need for a restructuring. And there are really three restructuring strategies. And we're going to talk about all three in the next three PowerPoint slides, and we're going to wrap up today's lecture. And that is downsizing, downscoping, and what we call leverage buyouts. So downsizing. Downsizing is defined as a reduction in the number of a firm's employees, and sometimes in the number of its operating units. So this is when we talk about downsizing. This is when we say people get laid off. This is, again, just as you know, underline this in your notes, it's a reduction in the number of a firm's employees. And we see this all the time. One example of this is ESPN. Recently, ESPN laid off a number of their employees. They didn't really change the composition of their business portfolio. They just fired employees, and let's say they had 10,000 employees. They downsized to 9,000 employees. And there's some reasons for this. Number one, oftentimes the expectation of improved profitability comes from cost reductions, meaning if you fire some people, there is a cost reduction in that, and you can get improved profitability, because profitability, of course, is just revenue over cost. And second, there's a desire or a necessity even for more efficient operations. And if companies need to have more efficient operations, one way to do it is to downsize the employees. So in terms of the first way that companies restructure, we call it downsizing. And again, it's a reduction in the number of a firm's employees, going from 10,000 to 9,000 without really changing the compensation of what the actual business looks like. Now, the second type of restructuring actually does change of what the composition of the business looks like. And we call this downscoping. This is when you have a set of action that causes a firm to strategically refocus on its core businesses. This is when a company says, you know what, I own too much stuff. Let's say Facebook said, I own too much stuff, I'm in too many different industries, I need to get out of the virtual reality gaming industry. I need to get out of the smart home industry. So what they do is they downscope. And we talk about this in terms of like spin-offs or divestitures. And what this means is that they eliminate business units unrelated to the firm's core business. So again, for Facebook, it would be high-tech social media. They are getting rid of or divesting or spinning off companies that are not related to that, like virtual reality gaming. And so oftentimes this results in a smaller firm that can actually be more effectively managed by the top management team, and that's kind of the primary reason why downscoping occurs. Now, the last thing that we're going to talk about today is something called a leverage buyout. Now, a leverage buyout is a restructuring strategy, and it's really unique, where a party buys all of a firm's assets, Company A buys all of Company B's assets, and they take the firm private. Now, what they do then is they take the firm private, and oftentimes they take the firm bankrupt, and they have an immediate sale of the non-core assets, which they pare down all the debt that was incurred to actually buy the firm. And so what they'll basically do is take this firm private, sell off their assets, and again, oftentimes this is a result of a failed acquisition. So we see this in a number of different cases. Oftentimes we see this when really failed acquisitions are pretty visible and managers try to kind of correct for their own mistakes. And it's very controversial because it's argued that CEOs and other top executives are trying to kind of serve their own interest and kind of cover their own selves compared to the interest of others like shareholders and other types of stakeholders in the company. However, it can also facilitate more opportunities in the market, more entrepreneurial growth, more strategic growth, because you are creating a smaller firm from this leverage buyout. So again, that's the third component or the third restructuring strategy or the third way that companies restructure. So in Chapter 7, we talked about mergers and acquisitions. We defined the three. We talked about conceptually how they're different. We then talked about the 7 reasons for acquisitions and why companies acquire, right? The first 2 are to increase market power and to overcome barriers of entry into a new market. And then we talked about 7 other reasons why these acquisitions oftentimes fail. Because again, as I mentioned, on average, acquisitions oftentimes lead to lower performance. And we talked about 7 reasons of those. And then we wrapped up the lecture by talking about, okay, well, when acquisitions fail, they have to do something called restructuring. And they can do that in a number of different ways. Really 3 ways, talking about downsizing, downscoping, and leverage buyouts. And we defined each one of these. So in sum, that is chapter 7.